That's mine. Hello guys and welcome to today's session. I apologize, we are a few minutes late. Blaine and I was having some last minute technical difficulties that we had to solve before jumping on. But we're here now, that's the main thing. And today we're going to be doing a Darwin review session. Instead of doing them in the way that I used to do them where we'd pick a Darwin and we'd go through all the metrics, I think what might be more interesting is Blaine has a specific Darwin, somebody who's actually forwarded their Darwin onto Blaine with specific questions about it. So I'd rather make it more of an interactive session. And if one of you guys has a specific question or a specific set of questions about your own Darwin or about your own account, I think instead of doing it like a rundown of all the metrics and all the data, we do more of like we'll answer specific questions around your own Darwin. I think that might work a lot better. We just make sure all the links have gone out correctly because I think yesterday we was having some. Was it yesterday we was having some issues with Twitter?
Maybe yesterday was it?
Yeah.
I can't remember.
The link was coming through as broken. It's through DC and send. Yeah, all looks good to me. So I'm going to hand over to my good friend Blaine, who is joining me on the stream today. And Blaine is going to go over the Darwin AEGM, who we've spoken to privately. Rob, I have clearly no questions. And yeah, yesterday. What? Rob,
no, it's in the exit club yesterday.
Make no sense. Mason, go on the boys. Welcome to the session, dude.
How are you doing?
Yeah.
Awesome. Yeah, I mean, I'll just get started, to be honest. So obviously you get people that reach out to you from time to time. It's always good to kind of help out. But, you know, I thought that today could be a good example where someone's reached out, wanted to ask a couple of questions, and we actually go over it in the live stream. So the question was around trade frequency. And let me just get up what the other question was. I thought I memorized it, but obviously not. So it was around number of trade frequency, trade duration, affecting multiplier, and how it affects, like, obviously your VAR. So again, it is a reasonably difficult one to sort of answer and give a defined, like, in other words, this is exactly what you need to do. But there is a few things we can go over today that we know, like, will actually have a knock-on effect to your multiplier. And from this, we can see that if we go to the assets, again, depending on like how much, like, for example, we have had increased volatility on gold and silver. You know, we can clearly see this using like ATR. And normally what you would do is if you're risking like percentage of balance is as things are less volatile, you'll probably risk the same, but more lots. And vice versa, when things get more volatile, you'll risk less lots. I can't even say the word lots. Jesus Christ. It's another word that screwed me over right there. So yeah, keeping like your actual like lot size linear all the time will have an adverse effect on your multiplier and your VAR, because one lot in a volatile market and one lot in a less volatile market, things are moving a little bit less, meaning that, you know, typically when things are moving a lot more, if we look at if we look at price charts and candles, we're trading, you know, most people will be trading like price action or some form or another looking at price. And the moves, you know, 1 minute candle in January is going to be a completely different to a 1 minute candle, I don't know, 4 years ago. We're seeing massive increase in movements, meaning that our stop losses will naturally probably be a lot bigger as well as take profits. So having linear risk in increased volatility will have a knock-on effect to your multiplier in the way that, you know, it will be seen as you're risking more in a more volatile market than what it would be if you were risk adjusting to percentage of balance and ATR as such. So I hope that helps in terms of answering that sort of question, because I know there's quite a few people that we've had lately speaking about grid systems. They're risking the exact same sort of lot sizing, and they're wondering why they're being de-risked. Well, that's exactly why, for the most part. Or that's the best answer that I can give. I'm pretty sure that's 100% why. Kieran, correct me if I'm wrong in that instance, but that's how I understand the risk engine. Mm-hmm. Regarding trade frequency and trade duration, these things can be very different. And again, it depends on how many open trades you have, open positions. As we can see here from this person, we've got the average losing position is almost 5 days, and the average winning is just less than 2 days. So we've got lots of open positions at one time. And if we're risking quite heavily and not like trailing a stop loss, or if we're letting things breathe, then we will see the equity chart move up and down quite a lot for it to either hit target or hit stop loss. And if you have multiple positions open, then your actual let me just get up to sort of the Monte Carlo area. The more that we have open equity, the more like these lines are going to be a lot more vigorous, meaning that it will need to sort of expand your VAR to be risk adjusted. It's keeping within this sort of blue percentile into the less risky sort of area. So that's why we'll naturally see, if we have swing traders potentially, if they're increasing size or keeping the size the same, we'll see bigger swings than what someone that's day traded in. Not to say that either one is wrong. Again, it's all to do with like keeping your risk in check. Make sure you're like managing positions as well, because if you have 10 positions open that swing, your equity is going to be wild. You could be at 1% 1 minute, then 0, then up 2, then -1. All these things, like a big zigzag in the equity, will obviously have an adverse effect to the VAR as well as the multiplier as well. So the whole point is to try and keep that risk sort of in a good, safe, linear area rather than increase, because it's all about protecting. It's all about being risk managers and protecting your sort of like balance and equity as well. So that's where like the trade duration can really have a sort of negative effect depending on how many trades you've got open, what the risk is in each of these positions as well. Trade duration, I think it was in the other sheet, wasn't it? Yeah, so the risk engine works in 2 levels. Every trader sends a market order, and depending on the market conditions at the moment, Darwin calculates the size to be open for the investor order, means that the target risk level in Darwinex guarantees to all investors. So this is what I'm on about, is in like, if you're risking linear lot size positions and you see an increase in volatility, this is why the engine will actually probably de-risk you in those sort of situations, because it needs to keep the risk within the target risk levels. So that's why you might see your risk multiplier go down when you're risking the same lot size through more times of volatility. And second level, while the trader's position remains open in the market, the risk engine ensures that positions do not go above the maximum leverage. So this is like, your leverage is obviously will increase, decrease, depending on how many positions are open, as well as what sort of lot sizing you're using. And here we can see the maximum leverage for positions for less than 50 minutes, leverage for less than 30 to 40 minutes. So we can see that the maximum leverage is higher the lower that we hold the trade for, or positions lasting, and it's lower for the longer the positions lasting. So this again will have an adverse effect on the risk engine. But from this trader, so sorry, that was just a lot of information there. Going back to AEGM, the trade frequency isn't too high. It's a lot less than me for the past 3 months. So I wouldn't say trade frequency is a problem here. Maybe trade duration, holding those positions a little bit longer and having the sort of negative duration ratio as well as maybe risking linear in terms of your commodity trading, might have an adverse effect as to why the multiplier is going down. If we look at the VAR, let me have a quick look at the VAR. I need to always remember where the VAR is. Yeah. So we can see that you've kept it very stable, but there is like an increase over the past sort of couple of days. So it will keep the multiplier, it'll probably make the multiplier go down a little bit. But for me, this is nothing to really worry about. I don't see any crazy difference in risk levels or anything like that. Even maximum positives, nothing too crazy there. So I would say just kind of keep what you're doing. It's nothing too crazy. It's not going to change the risk engine by much. So I don't see it increasing much more, depending on how much you're risking and how much volatility kind of picks up. So yeah, I think that's me just kind of covered that. I don't think there's anything else. Do you have anything else to add to that, Kieran, in terms of reviewing this sort of Darwin?
Nothing from my end, dude.
No?
I mean, you know, yeah.
Awesome. I mean, there's not too much data to go based on, like 103 trades. There's not a lot of trades to sort of base anything on. But yeah, I would say just keep everything the same way you are. Your VAR's not going crazy. It's still within a decent level. It's just reduced a little bit from 0.47 to 0.45, which is minimal changes. So I wouldn't worry about it. This is eye-opening. I have fixed lots for all trades. Probably explains some of my confusion. Yeah. So, you know, I don't think there's a problem with fixed lots, but just understand that, you know, during times of where we see increased volatility, you'll see either, you know, bigger returns, bigger losses, depending if you have static stop losses as well with fixed lots. So yeah, this is a reason that I always do percentage-based balance stop losses with ATRs. So then I'm going in line with current volatility. So the VAR system kind of complements that, if that makes sense. That's just the way that I've always done it. So yeah.
How's the charity going? I actually haven't checked the charity Darwin in a few days. We're up on a position right now. It's down like $600 at the moment. We're still down from I think I mentioned before the rogue S&P trades that we had, which actually leads into your second question about strategy quant. So we had a couple of rogue positions that were in a little bit more drawdown than we would have liked. So we decided to close them and kind of take the hit, which I don't know if you can load can you load the charity Darwin up, Blaine?
I don't, for what, on the VPS or the ticker? I don't know.
The actual Darwin. It is QWNK.
Q.
Yeah, so you can see that was that big trade where Blaine is highlighting now. That's where the S&P, that's where we closed the S&P. So you can see since then we've just been kind of break-even dancing. The problem is we don't have too many strategies on there right now. And to be fair, Feb and March have been pretty tough months anyway. I think both Blaine and I agree on that.
Yeah.
So hopefully, you know, in next 6 months, some decent on there now. Ideally, we can get some more in the next sort of month or two. So yeah, that's kind of how it's going. I would like to get a performance fee, ideally in Q2, if not Q3 this year, and then we can, you know, kind of move on to the next step, which is choosing the charity, getting you guys to vote on that sort of thing, you know, and really seeing the benefit of doing this. Your next question, you'd love to hear your thought on strategy quant. You haven't talked about it in recent streams. Yeah, so I've taken a brief hiatus from using strategy quant. I've got a couple of really good systems. It's notorious for overfitting pretty much everything that you build. So I need to have a bit more of a think about what I'm building, how I'm building it, and the process. Like I say, I've still built some pretty decent strategies, one of which I'm testing today. And the only thing I'm doing is after it's been built on strategy quant, I'm kind of taking the idea and I'm making my own amendments to the file, adding my own filters in, adding my own security protocols in, because strategy quant is very lax on that aspect compared to other You know, if I was to build a file manually on FXDreamer, I can add all of my security protocols in there and then, i.e. spread filters, slippage filters, all of that. Whereas strategy quant, to my knowledge, doesn't have any of those natively built in. So it's a little bit more difficult to implement them. So I just implement them myself. Hence why I've got some really good strategies from there, but it's very few and far between. It's a very, very interesting platform. But Blaine and I have spoken about this in great detail privately recently, is perhaps strategy quant is better as a data mining operation for ideas instead of, you know, full scale idea to build, then implement. So I think when I actually go back to SQX, which will probably be after I finish my Q3 review of XAQP, where I make all the changes and adjustments I need to, I'll probably start using it just to data mine ideas, and then I'll take those ideas and I'll work on them manually. I think that's kind of the direction that we're both going to take it, really, isn't it, Blaine? It's just idea generation and you know, finding small edges that you probably necessarily wouldn't build. You know, if you're looking to build a file with, I don't know, moving averages or price patterns that you'd build on FXDreamer, talking more like, I don't know, for example, one of my strategies that I'm testing right now actually is an Ichimoku. It's an Ichimoku Senku span. I don't know what that means. I don't know what it does. I know what the strategy does, but I wouldn't know how to build that. But it's pretty decent as far as the strategy goes, but I've had to put a lot of my own things in myself. I'll share my screen actually for 2 minutes just so I can show it.
It's just showing, do you see, Kieran, that like the S&P is the reason that we're actually down on the charity Darwin there?
that doesn't surprise me.
And then
like it's all because of that.
And then if you see, this is the position here, you can see a maximum positives. So apart from that one trade, would have been fine. You know, it's interesting like that. So I just wanted to share that before you moved on. So I'll take that away from the screen.
Let's go. Ba-ba-ba-bam. Oh, there's about 400 of us now. You're getting private access to XAQP intellectual property here because, damn, look at that open profit. So, like I say, it's a strategy built on Ichimoku Senku span. Ain't got a clue what that means, but I've added in, for example, on strategy quant, I built it as fixed lots. I've now changed that to risk per trade, so I had to build this. I've added in, this is all from strategy quant, so exits on Friday. This going back to what I've spoken about in yesterday's session, and I will be doing a proper, like, sort of official session on this about splitting entries and targets. The reason being is for capacity. I'm not going to go too much into detail now, but it's something that I'm really looking to do. In fact, if I'll bring it up for the guys who missed yesterday's session. I'll explain what I mean, just briefly, if it ever wants to load. Let's move streaming out over to my other screen. It doesn't look like it wants to load.
Speed dial. Who are you phoning?
I don't know why it comes up as speed dial. I think it's my internet again, Blaine. Whenever I'm on calls, it just goes really slow.
Lately, it has done, yeah. When we first jumped on, it was me that had the problems. Now it's like reverse.
You're right in the sticks, aren't you? Yeah. So this is XAQP, so this is mine. So I'm going to come into the investors tab down here, and you can see that my true capacity is actually already at 40.81%, which means that at 1.6 million, just work that out, percentage calculator. Which one is it? What percent? What is 40%? I don't think I can do it here, can I? I don't know. I'll just have to do the mental maths. So if my capacity, if I've used almost 41% of my capacity, and that's with 1.6 million in investor capital, my true capacity is probably around 3.5, maybe 4 million as of right now, due to my live executions. So if I scroll down a little bit further, I mean, you can see this only takes into account the last 100 orders. Okay, so that's orders, not trades, because a single trade is 2 orders. You've got an order to get in and an order to get out. So this measures your entries and your exits of your positions. The 0 gray line in the middle shows a divergence of 0. So that's where you're not being slipped positively or negatively, or not necessarily you, but the investors who are backing your Darwin. The green dots are where your trades have been positively slipped, so an investor's experienced a better fill price than you did. And the red dots are where an investor, which is true investor capital in Darwinex, so that's what we're taking here as the measurement, has experienced a worse fill than you have as the trader. Now you can see my average divergence is at the moment minus 0.16 pips. So that's on average how poor the fills are for my investor, which isn't too bad. But then you can see that I've got some kind of rogue trades over here. We've got silver, Kiwi dollar, and a couple of S&P 500 trades. And now that's really dragging my live capacity down because the divergence on those specific positions was quite large and way past the level of 0.8 pips, which is where my Darwin should be closed. And therefore, it's eating up a lot of my live capacity. So essentially, when I get to about 3.5 or 4 million, my Darwin will be shut off, regardless of what my hypothetical capacity is, setting the capacity attribute up here. So we scroll down, I think mine's about 25 million. Okay, 23 million. So it's dropping every few days, which is interesting. I'm presuming it's because of the recent trades that I've had. For example, these S&P trades, that was this week, funnily enough, I think. That's the one that was this week. So I had one last week on Sunday and this week on Sunday. So I think this strategy may have to be turned off to be completely honest, because it's going to hold me back from a capacity perspective. Anyway, I'll do a proper session on this because I think it's something that we can dive into in some really great detail. We'll also be putting out some written content on this because it's vital for us as a company that all of our traders are taking this into account. Because if you start getting into the index, our capacity is based on your guys' capacity. And what I mean by that is we can only invest how much we can invest. Like if we invested 4 million into me, I'm at capacity, which means if I'm trading on index capital, they can no longer allocate more to me, right? So it's going to start skewing the risk from an index perspective. And so it's really important that we get this message out to as many of you guys as possible. Now, what I'm doing, and bear in mind, I'm a systematic trader. So on one hand, it's easier because I can code it in and, do that once and it will do it for me automatically moving forward. But as a discretionary trader, it's easier. On the other hand is you can start doing this tomorrow. And after 100 orders or 50 trades, you're going to see an update in your live capacity. For example, if I'm splitting orders for the next 50 positions, I'm going to reduce my market impact, meaning I'm going to increase my live capacity because the investors are going to be getting slipped less and less. And the reason that splitting orders is so important is because we can add a delay between the entries. So you can see here, I am splitting this, and this is just an example system that I have, and it is on XAQP. So I put a number of split positions and I've set it into end positions on the strategy. So I can choose between 1 and 10. So you can see I've split it into 5 and with a 5 seconds delay. So the first position will fire based on the criteria of the strategy. After that, every 5 seconds, the system will fire the second entry, the third entry, the fourth entry, and the fifth entry until it has 5 entries active on that trade, or 5 positions on that trade. Then it will also do it upon exit. The way I built it, and I will give this out when I do a proper session, I'll give this code out. So if anybody is trading systematically, you can just implement this straight away. The risk will be on you guys. I'm just providing it as kind of a friendly face in the Darwinex ecosystem. But you guys will have to go away and either build your own or stress test the one that I provide to you. And what it will do, like I say, it splits the entries. It will split your targets. So if position 1 hits target, position 2 through 3, 4, 5, 6, 7, 8, 9, 10, they won't have targets set. And what it will do, every tick, it will check if position 1's hit target. Then it will set the delay again. So after 5 seconds, position 2 will close, position 3 will close, position 4 will close, and so on and so forth. However, the caveat to this is all the positions will close at the same time if the stop loss is hit, because you don't want a delay on that. So the stop loss doesn't get affected. But the goal here is to reduce your toxicity in entering and in exiting. 3, 5, 10 seconds between each order. It doesn't sound like a lot, but it's massive. You won't wipe out the book. There's enough liquidity to facilitate all of them, all of the individual orders. But in one go, you are going to have a pretty decent market impact, especially if you're trading lower liquidity assets. So if you're trading something like, again, one of my systems trades the S&P on the cash open on a Sunday evening, not great for capacity. It's a great system, but I don't think I think I'm going to have to remove it purely from a capacity perspective. So anyway, enough about that. I'll run this as a test so you can see, and then we'll jump back into the Darwin reviews. 5 positions. Stop loss true. Max risk monitor. I think I have this. Do I have that set?
I think what's good though, Kieran, is like, the ones that are struggling with your capacity, you could always open a second Darwin and have your lower capacity Darwin running these strategies, because it's clear that they're worth trading. It's just affecting, I think this is the thing. You could have your main flagship Darwin that you want as much capacity as possible. Then you could have a sub Darwin that has great strategies, but it might struggle a bit with capacity. But you're not too bothered about it, because either way, you've got your main one, and then you've got your sub one as well. So if it affects the main one, then get rid of it, put it in a second account, and everything could look even better.
Yeah, absolutely.
Instead of just retiring systems just because they don't meet capacity, you can always just build a second one out that you're not going to need to worry about capacity on the second one at the moment. So I think that's interesting as well. Yeah. Do you have a second one? Yes.
Maybe I'll put it on the charity Darwin at least to begin with, to get some some decent trades through the floor.
Exactly. We're not in capacity in Darwin, our charity Darwin.
Not yet, anyway.
No. So
it's its first trade.
Yeah, Rob. I actually have 3 accounts. One is just a test account for futures at the moment, still in calibration. My other one is literally just research and development Darwin. So it's still up, but it's going through a little bit of a tough year, to say the least. But I've got a lot of things testing on there that I've never tested before. I mean, I can obviously show the Darwin anyway. I accidentally bought a booster on it as well by accident.
Oh yeah, that still crazy as well.
So I'll show that. We'll cover Jay's Darwin after Kieran's went through this. Then I can show you that one as well.
I just want it to enter a trade so I can show it splitting the orders. It doesn't look like it wants to. It keeps setting pending orders and then removing them.
Yeah, sometimes it do.
Trust. To be fair though, there we go. So you can see there's multiple positions here. There's not much delay on them in terms of like price moving too fast. Like, because the worry I had was, if I'm delaying the entry, is it going to affect me? I haven't seen an issue yet. So you can. Oh crap! Let me pause it. So you can see none of them had a TP. Oh, well, to be fair, none of them have a TP set anyway because of the way that the strategy works. But you can see entered at 54.37. 5 seconds later, the second trade went in. 5 seconds later, 5 seconds later, 5 seconds later. I think they all closed together, which is a bit of a bummer. Because that defo. No, here we go. So we can see market buy euro dollar because we were short. So we closed the first order at 10 p.m. And then you can see if we go down split short, market buy 0.4 at 5 seconds after. So 5 seconds after the first trade closed, it then closed the second trade. 10 seconds, again, 5 seconds after position 2, closed the third trade, and so on and so forth. So it split them all by 5 seconds on entry and on exit. Now, hopefully that is going to, and I'm rolling this out across the board for all of my strategies because I really want to increase my capacity. I've kind of said this to Blaine a few times, is at this point, I'm trying not to worry about performance too much because that's already taken care of. The strategies are doing well. I need to stop worrying about that. And I need to worry about scaling and capacity. How do I get this bigger than it already is, right? And I could be so, I could lock in on performance, try and make the best systems possible, keep going, and keep going. But if my glass ceiling is at 2 million, 3 million, 4 million, well, guess what? I'm already almost there, which means that my growth is stunted for the rest of my career, right? And that's not good. I want to be able to smash through that glass ceiling, increase my capacity tenfold, 100-fold, 1,000-fold, you know, and keep scaling as a trader. So anyway, I thought that was, I thought that'd be interesting to show, just because it's something that I'm actively working on. I've been having conversations with Javi around it. I've mentioned it a couple of times on these streams. I'm going to do a dedicated stream on it as well. But I think the earlier you guys can think about this and start implementing this, it will pay off dividends in the future, big time.
Absolutely.
Anyway, I'm going to let this test rerun. Blaine, do you want to do the review of where in the chat?
G's GSQT.
Let me stop sharing my screen.
Okay.
There we go.
Awesome. So Jay, this is your Darwin, and started in December. So not too long a track record as such. Decent. We're up on the day, which is nice. Yeah, so far everything's looking pretty stable in terms of returns. Really low drawdown at the moment, so looking good. Yeah, nothing too bad in terms of worst days or drawdowns, so nothing to worry about there. Let's have a look at your trade history in terms of assets. Interesting. So you've got like a pretty decent win rate, probably just below 60 with everything. Have a look at the assets. Dollar yen down, euro dollar down. So where's the returns? Okay. So gold and silver. Yeah. Gold and silver have been really good lately as well. And you've got a good distribution as well between the 3 sessions. I mean, for me, there is only 213 trades over 3 months, so not enough to say anything in particular. But at the moment, everything's looking pretty stable. Even like days of the week, we've still not got enough data to say, okay, maybe you need to look at Tuesday, Wednesday, Thursday. Yes, right now, I think Thursday's down at the moment, Friday's up. Yes, we're not trading since then. So there's nothing really to be too worried about in terms of days a week. Again, this is something that maybe have a look at after you've got significant data. So we're speaking probably closer to the 2-year mark before anything is substantial, I would say, because even a year data is just not enough for looking at days of the week. And again, have a look at your back tests as well. So like in a back test, Tuesday might not be good, but you know, if that's not good in the back test and in the next 2 years again, say it's not good, then maybe it's worth removing. But again, I'm not too big on removing certain days of the week for the most part, only if it is completely and utterly obvious. I will look at different sessions, like removing some sessions can be helpful for some systems because, you know, again, it makes sense depending on what asset that you're trading as well. For example, if you're trading indices like NASDAQ, S&P, like, you know, Dow Jones, the Russell, maybe around when the American markets are open, that's maybe the best sort of trade window to trade around, especially, again, like touching on what Kieran said as well, that could be a big effect for capacity as well. So looking at liquid hours for certain assets is definitely worthwhile, maybe using as a as a filter for capacity as well. But so far, everything's looking pretty stable. The only thing that maybe concerns me a little bit is the long exposure. But again, it's 3 months of data. Gold's been going up. My guess is you've been, you know, pegging the longs on the golds and silvers like a lot of us have. So, yeah, I would be, again, there's not enough data for me to say watch out for that long exposure. So if you do go both long and short, maybe have a look at it 2, 3 years down the line. But again, that can also depend on what assets you're trading as well. You know, if you've got predominantly long-only strategies on indices as well as gold, then obviously you're going to have a higher exposure to the long side. You know, win rate is decently as well. What I do like to see is, this is just me from my preference, because it's the sort of trader that I am. I know it's not everyone's, but I always like to hold my winners a lot longer than I hold my losers. So I like to see that as well. But that isn't to say it's wrong, because we have seen so many times the actual adverse of that, and people do really well. So looking at the VAR as well, the VAR is very stable, which is what I like to see. But it'd be interesting to keep an eye on this, and we can review it in, say, 3-6 months down the line to see, has the VAR changed, has anything changed, and then we can maybe do a comparison review at that point in time and see what changes there are or anything like that. So yeah, everything looks good. I would just keep up what you're doing. The equity curve's looking really good. Some people are struggling in 2026 in Europe, so well done to yourself. Keep up the good trading.
You send some signals.
And hopefully we see you in gold in how many months' time will that be? 1, 2, 3, 4, 5. Another 3-4 months.
Yeah. We load it up on Classic as well, Blaine, so you can see his hypothetical capacity. I like some questions. Fulfillment, hi folks, thanks always for the excellent content. Appreciate that massively, dude. If a trader starts splitting orders for the first time, will this cause a risk adjustment filter to trim more than before? No, it won't. So so when my orders are being split, I'm still using the same risk. It's just splitting it. So I did a video about this before, some short form content on this. I'll see if I can dig it up, or I'll dig up like the transcript for it, or the idea behind it, because it's important to understand. So you can enter multiple. I'm going to butcher this because I'm going to get it the wrong way around. You can enter multiple trades that build up one position, or multiple. I think that's the right way around. It's not multiple positions to one trade. You can take multiple trades, but it all forms one position. So it doesn't matter whether it's one lot coming through, or 2.5 lots, or 4.25 lots. It will all account towards one position on your Darwinex account, or on your Darwin, which then gets the deleverage of the position, not the trades, not the individual trade. So the position overall, it then gets compared to the euro dollar, and the deleverage over at the euro dollar, and that's how the risk adjustment works from the risk engine. I explained it in a little bit more detail because it's been many months since I've had to explain that. But long story short, you haven't got to worry about that because it takes the position as opposed to the individual trades. But great question. It won't get involved more. No. Mason said, "Glad I've learned this before building my first strategies." Thanks. Absolutely. If you need, send me a message on Discord or Twitter, whichever, and I can help you put together the order splitting if you're struggling with it, just so that it's as similar to mine as possible. If you've got it, fantastic. If you can build it yourself, fantastic. But if not, just ping me and I'll see what I can. I'll see if I can send you the code that I have for it.
I've got a question. How do I even search for it in Classic?
So
GSQT here, nothing comes up.
Go onto IME's page.
Yeah.
And then in the URL at the top.
Right. Yeah.
But then put a hashtag at the end, because sometimes it doesn't work without the hashtag. It's really weird.
See, I've never really looked at it on this one, to be fair. I always look at everything on Darwin.
I always look at both because there's different things that you can look at on each one.
All right.
Welcome, dude. All well, my end, mate. I hope everything's good your end too. Fulfillment, got it. Thank you, Kieran. No, absolute pleasure, dude. Back over to you, babe.
Capacity. Yeah, so capacity 25.55 million at the moment for J. So yeah, it's staying roughly around that same thing the whole time. Use capacity 0. Yeah. So yeah, the capacity right now for your Darwin is 25.55 million. I've always wondered here, right? See, when you press Alt, right, your max investment goes up here. You can't see because it's. See what I mean?
What do you say?
See, when you press All here, it's your max investment changes. See if I do 3 months.
That's probably because it's isolating the divergence sensitivity just to just that period.
Yeah.
Because it is all hypothetical, isn't it?
Yeah. So even when you do it all, Jay, your max investment's about 25.55 million, which is a decent size. I wouldn't be too worried about it at the moment. Again, as Kieran said, if going forward you're getting investment and things are looking good, then it is something worthwhile to think about. Austin touched, so that would be the real capacity. I would assume it's much lower based on what Kieran. Yeah, I mean, to be honest, right, it depends what you're trading, depends on what's actually happening as well. These things will be changing. Like for instance, 6 months time, even if Kieran didn't make adjustments, you might see a different value based on what the volatility is like, what's happening in terms of the slippage and things like that. Again, it's all based on like the last 100 trades, is it? 100 trades?
50 trades, 100 orders, so entries and exits.
Yeah, so 50 trades, so it's always going to change. But what it does show is during volatile times, you will potentially, investors, if they had more than that, potentially would see slippage, seeing an adverse negative effect. Mm-hmm. So yeah, I wouldn't be too worried about it right now, but let's say 6 months, a year's time down the line, everything's going well, then it's definitely worthwhile putting in the work in the background. Even if it's just one every so often, it's going to pay dividends in the long run.
Mm-hmm. Yeah, I just add to that as well. There's no relationship between the hypothetical and the real capacity. It's just the hypothetical is what you potentially could manage based on the assets that you're trading, your frequency, the liquidity of them all, etc. The real-time capacity is kind of what we're seeing from live investor execution. So obviously you're not going to have that data until you start taking on investor capital. So I would just kind of work off of the notion of the hypothetical capacity is what you're working toward. And then when you get the data for the investor capital divergence, that's when you start going, okay, well, my true capacity is 4 million or 5 million, but I know it can be far higher based on how I trade. I just need to adjust the way I trade. So yeah, Rob, if your risk multiplier was 0.13, would you restart? I wouldn't restart based on a risk multiplier. The risk multiplier and your value at risk is like a seesaw, and it's perfectly balanced. So if you increase your risk multiplier, then you decrease your value at risk, and vice versa. And the Darwin always comes out to the same result. So I wouldn't restart based on how much risk I'm taking, because essentially that's what your risk multiplier is showing. If you're not happy with that for whatever reason, then try and gradually bring it up over time. But your Darwin's still going to be coming out to the same result, so it doesn't really matter long term. Son of the King, I don't know what liquidity providers Darwinex uses for Eurodollar, but just wanted to say I can see the book. My personal trading account, Eurodollar, has 40 million sitting within one bid on bid and ask. So we aggregate 2 LPs, and we take the best execution from whichever one's giving us the best execution at any given time. I'm not sure if I'm allowed to mention who those LPs are. I think I probably have in the past. I mean, I guess I am, but I don't want to put my foot in it. There's another Darwin as well, Blaine. Jenny Zool. I feel like I recognise that name. I feel like it used to come to the sessions in the past. Said, hello guys, can you make a review of my Darwin? It's my 2nd month. Yes. So there's going to be an issue with that, just in terms of we're not going to have enough data to do a real kind of review on it. But he said, I want to upgrade my multiplier because it's 0.09. I don't need more that 0.2. My Darwin, I don't know what you mean by that. My Darwin is WFES. I'm presuming that you mean you want your multiplier to be 0.2, which effectively means you need to trade half size from what you have now. All I would say is, well, there's 2 things here. If you're going to change your risk multiplier, okay, I make 8% this month with 0.09 is not impossible with 0.13. So, okay, I'm going to be brutally honest here. So your risk multiplier is just an unbiased representation, an unbiased insight into this trader, right? Because like I say, it's on the inverse correlation with risk. Now, the issue is you get caught chasing the tail by trying to change the risk multiplier. Like I said, it's like currently using So you have the value at risk and your risk. You've got to increase your value. So the problem is here, you get put across the tail and it's going around in circles, trying to.
I wasn't too sure if that was just me or.
What's going on? Can you not hear me at all?
Yeah, it sounds like you're under the water.
You know what it is? I bet you it's not on my microphone, is it? How's that sound? Is that better?
Yeah, 10 times better.
I bet you that was on my webcam, and I dropped my webcam earlier, and it absolutely smashed, didn't it, downstairs?
Genuinely, I thought it was me to begin with. I was like, maybe it's just me again with the connection.
Was it for ages, or was it just a few seconds?
It was just as soon as you started the explanation.
Oh. Okay.
So rewind. Let's take it from the top. Go.
Okay, so rewind. So what I was saying was there's two things here. One, you can get caught chasing your tail because okay, perfect. You can get caught chasing your tail here with trying to increase your risk multiplier because it is a balancing mechanism between your risk multiplier and your value at risk. So if you reduce or increase your value at risk, i.e. changing your position sizing, then your risk multiplier is going to do the opposite. So if you start taking less risk, your value at risk is going to drop. Blaine, can you scroll down to or go on strategy analysis, please, so we can see the value at risk? Let's see what it is.
Yeah, it's near 50.
Okay. Yeah, so your VAR is quite high, right? So essentially what this means right now is you're almost 10 times as risky or as volatile, let's say. I don't like the word risk. You as a trader, you're about 10 times more volatile than the S&P 500, right? That's fact based on the size that you're trading, how long you're holding the trades for, etc. Now, if you start to bring that down, your risk multiplier will increase. However, the Darwin is going to come out at the same results anyway. So let's say, for example, you had a value at risk of 13%, which means that your risk multiplier is going to be 0.5x, and then you take a 1-lot trade. Your Darwin's going to end up taking a 0.5-lot trade because you have a risk multiplier of 0.5 lots. Oh, sorry, 0.5x. Now, let's say you brought your value at risk down to 6.5%, and that brought your risk multiplier up to 1. Well, you're going to have to reduce your position size to do that. So now you might be trading a 0.5 lot at signal account level. But guess what? You now have a higher risk multiplier of 1, but your Darwin's still going to come out to the same result as 0.5 because it's doing a 1x of 0.5 lots. So your Darwin will always come out to the same result or near enough the same result anyway, which is why I don't want you or anybody else listening to this getting caught in this loop of trying to change your risk multiplier because it genuinely won't serve you long term. Having said that, my piece of advice to you is 54% value at risk is very, very high. And what we see is, or what we've seen over the past 14 years of Darwinex being around is kind of the level that we have a little bit of worry above is 30%. Anything above 30%, there is an exponentially large increase in chance or probability that you will blow your account at some point. It may take a month, it may take 10 months, it may take 10 years. And it's not to say that that's an absolute guarantee that you will blow your account. And it's not a guarantee to say that if you're under 30%, then you're not going to, grind your account to zero. But what I'm saying is there's like a gradual increase in probability. The more risks one takes, there's a gradual increase in probability that you will blow your account. As soon as you hit that 30% level, there's an exponential increase in probability every sort of percent value at risk that you go up. So I would say trying to reduce your VAR over the next 3 to 6 months would potentially be a good thing. And all I would do for that is slowly bring your position size down. So, for example, if you're trading 10 lots now, maybe on your next trade, you start trading 9.9 lots. Then after a couple of trades, you trade 9.8, then 9.7, 9.5, 9.3, and slowly bring it down over 3 to 6 months. And the reason that I say bring it down slowly is because your value at risk and therefore your risk multiplier takes a 45-day average and a 6-month average, and it compares the two to ensure that you're not being over or under leveraged at any point. So because it's taking an average, you don't want to drop it down instantly or increase it instantly. It's better to bring it down gradually because the average will adjust over time in a more seamless way. I would say that would serve you massively, and it would satisfy your goal of increasing your risk multiplier. However, don't get lost on that. Don't focus on trading as best as you can. Like, try and be the best trader that you can, and just have this as kind of a side quest. Bringing your value at risk down slightly. The great thing is, and what you should take kudos for here, is the stability of your VAR. It's very, very stable, even though it's quite high. So that tells me that even though you're probably risking a lot per trade, you're not doing anything that I should be concerned about in terms of martingaling or gridding or trading one lot here, but then 10 lots the next trade, and varying your size too much. So I would just say try and bring it down over the next few months. Yeah, 30% VAI is fine for me, I think. And that will probably bring you to your goal of risk multiplier anyway. Because if you're coming up into like almost 60% and you've got a 0.09 risk multiplier, if you basically half your value at risk and bring it below 30%, then your risk multiplier will effectively, or should effectively, double in that same time period as well. Anyway, done. That's me. That's my speech and my rant over.
There we go. All useful. Damn, though. It's a lot of trades.
How many trades is it?
3,875. Who's Torrences in the chat?
Jenny Zool.
This is one Jenny's.
Mm-hmm.
Jeez. Fair play. I don't know what your MT5 dashboard must look like on a day-to-day basis.
Manual trader. Wow.
No, I don't think.
On average a day? 100 trades a day. Wow. Okay. Oh, look. Do you just sit there and go, sell.
Crazy. Fair play, though. Fair play. Out of my perspective, you're taking that many trades a day. Thing is, though, like, average loss and winners are pretty much the same. 2-3 hours. Interesting.
I mean, there's a positive payoff ratio with a 60% win rate as well. It's still too early to like take it as gospel, but it's showing good signs, and that's the main thing.
Yeah. My guess is you're taking multiple positions only in the trade. Yeah, but must be like loads of low risk positions adding up. That's what I can only base on looking at what's going on in a day-to-day basis. So how many days is that? So been around since Feb. That's only 2 months. Wow. If you're a manual trader, that is fairly impressive. Because I've not even hit that automated in like 3 years. And I thought I took quite a lot of trades. But if you're splitting up positions and things like that, it makes sense. So
Blaine, check the capacity for this Darwin. I'm eager to know how much it'll manage, because this is basically what I'm talking about on order splitting.
Capacity is massive.
See, I mean, it's proving what I'm saying, right?
628 million.
Well, there we go. There we have it.
To be fair, 4.4 billion at the start. So they're
come on, you got to fix it up. Losing all your capacity.
Yeah, I think Jenny will be fine if everything keeps going the same way.
I'm not sure you can make a living off of that sort of capacity, to be honest.
You probably also
UF said, so basically for the risk, just trade like normal. My system tells me to risk either 1 or 2% depending on conditions. Yeah, so I would say trade and manage your risk like you usually do. Oh my life, it's 5 p.m. already. We're sure dollar yen just closed. I can't believe it's 5 p.m. already.
Yeah, just pinged there. 32 pence on one of the trades.
All I'm going to say, Danny, is 1 to 2% is a big increase in.
The mic's gone again. Oh, sorry, I just had to cut you off there before I just let loose for another 5
Is
minutes.
it still gone?
Yeah, no, you're all right now.
I don't know what's going on. Maybe it's my computer. Maybe my computer is telling me recently that I just need to get a new PC, but I don't want to because it's still fine. I might spend some money this year and upgrade it. Yeah, the increase from 1% to 2%, like this is where people mistake this, and I don't mean this to come across like kind of like saying that you're doing anything wrong, because I don't mean it that way. But people misrepresent this. I think we're taught as like retail traders by basic educators that we should be risking 1 to 2% per position, which is fine. Like, I'm not saying that won't work. However, what I am saying is that that's not an increase of 1%. It's actually an 100% increase on your risk from a mathematical perspective. So just be careful with that, because you're basically saying at your discretion that this trade is twice as good, and therefore I'm going to risk 100% more than what I did on this trade. And you're kind of like, I don't know. You kind of, I guess you've got the data and you've got the discretion to back that up, but it's something that I think when you think about it a little bit more, I would probably bring down the band there slightly. From 1 to 2%, maybe 1 to 1.5, 1 to 1.25% on, your A-star setups or whatever you risk higher on, just to bring down the variance between the two. A lot of traders would stop blowing up if they stopped varying their size so badly. And I'm not saying that's you. I'm just saying food for thought. Try and run some tests. Go through your previous trades, go through your journal or your back tests or whatever you have, and see what would happen if. Try and run some simulations to see what would happen if you varied your size versus just traded a fixed size or kept the risk percentage the same. I will eat my words. If you come back and you say, listen, I've done all that and it tells me to double my risk on certain trades, fair play. Absolutely don't listen to what I'm saying. But if you haven't done that test, I would 100% go away and do that.
Yeah, I would also add on to that, like put your statistics through Monte Carlo analysis as well, because as much as like one thing that I found from live trading back testing is the live trading might say, this is going back when I risked 1%. We've all done it at some point. There's nothing wrong with it. But my mind changed when I put it through Monte Carlo analysis, and I realized my 12% drawdown for my testing could, in fact, with the amount of trades that I take based on pure randomness, be 30% drawdown. And that's just, that's me saying that I'm going to execute my plan 100%, and history is going to repeat itself. So, that's the reason that I've moved to more low risk, because Monte Carlo analysis sounds quite bad, but like less important, because your drawdown's not going to be 30% risking 1%. If you're risking 0.1%, it's going to be it's going to go from 1 to maybe 1.5%. So you're seeing so little variance as well. I think that's why, if you're risking 1 or 2%, definitely put it through Monte Carlo analysis. If you have, actually, why don't we just do something like that?
Go on, Blaine. Ain't no messing about around here.
No. So I want to see if we can get one where if we risk a certain, this is horrible. Let's see if we can get something like this, right? Yeah, 1%. No, I don't want notifications. So based on DarwinX, 100,000, right? Let's say number of trades per month. Let's go over, I don't know how many. Win percentage 55. I mean, again, this is, again, it depends on, if you tell me your strike rate, this could be quite a good exercise online. So, Dave, if you tell me your strike rate, this could be quite interesting and something to not scare you, but be a bit more educational as well. What a decent strike rate for me was 40%, because that's roughly I think I was like 41, 42%. Break even trades were like 10%. And I would take about 15 trades a month. So I knew that, no. So it was 3-1, to be fair. So where is it? Is it going to show me like where the maximum loss is? Worst. Yeah, this is not doing it properly. 5. Yeah, I don't think this is a good one. This is not doing it properly with the math. Because it would not be 1% risking 12% drawdown based on 1% risk at 40% win rate. That is not going to happen. Maybe that's what we do. We find a good simulator that we can show these sort of statistics, Kieran, in like one of the Darwin reviews going in the future. Quite cool to show.
Maybe we'll build our own.
Yeah, maybe we will. Because again, you can see if this is what your back. So hypothetically, right? This is your line. Okay, this is your back test result. Look at all the other randomness that you can see, and this is all just different sequences of your trades taken. So this is based on history is going to repeat itself in the future, but let's jiggle up the sort of when the wins and loss comes. You know, we all end out at the end result the exact same, but what we see is how different the lines can be, and this is true. Like, you know, even from live testing, I've seen totally different sort of results going forward from my back test to live, and it can show you that, like, you know, you could come down to, this is probably not a good example for 1%, but you know, the drawdown, it's, you know, your equity is winning, but in a different random sequence, you're actually down at the same point. This can happen. It's just part of trading and randomness as well. Again, these sort of things will happen more if you're only trading one asset or one strategy, essentially. The more strategies that you do add, the more sort of squeezed Monte Carlo becomes as well. But yeah, it's not a good example, to be fair. We'll find a good example for another time. But just to explain that, you know, putting your strategy through Monte Carlo is probably very important to understand what could happen. You know, it's when we build a strategy out, in the ideal world, it replicates the future. You know, there are some strategies, you know, Kieran will say as well, like some strategies have, touch wood, replicated the past to the future, but there's some that will be very different as well. So what are good resources where we can find a few nice mechanical strategies to test? I mean, just some of the things that I've shared in the live streams as well. Like, there's so many sources that you could build systems quite easily. Also, just ask Gemini, ChatGPT, give me, I don't know, 5 breakout systems. Start from there. Like, I think the thing is, like, I don't think any idea is a bad idea. Some ideas will give you bad results. Some ideas will give you good results. It's all about the process of what you do and how you put it through. It's not a simple case of you find a strategy, you build it, you put it live. Like, there's such a big process to actually get to the stage where you should go live with a strategy, especially for intraday trading. Very few books on intraday trading strategies that are quantitative is in my limited reading. Yeah, the reason that you don't see many intraday trading strategies is because intraday trading is the hardest thing that you can possibly do. So, and if someone finds anything that's good intraday, they're never going to share it. It's just the truth. You know, it's just the truth. If you find something that trades intraday, you don't share it. It's just reality, I'm afraid. That's why you don't read any good intraday trading strategies. Because you know, we both have a couple, but you know, we would protect our lives with it, to be fair. Because there are some that are just too good to share. That's the truth.
Yeah, rare to come. I have some strategies, so I always test, like, when I'm testing a system, I'll always test what happens if I close at the end of every day, what if I close at the end of every week, and what happens if I leave the trades open and let it run to a stop and target. And quite often, strategies that the strategies will perform well if I close them at the end of week or if I let run till stop or target. If I choose to close them at the end of every day, quite often they blow up. You know, there's, like Blaine said, there's only a couple. I think I've got a few, not many, sub 4 or 5 in my portfolio that closes every day. In fact, I'd probably say less than that. It's probably 2 or 3 that do. It's yeah. The only rule I have now is I always close over the weekend. I learned my lesson. I learned my lesson when the war with Iran kicked off, and it wasn't. I actually didn't get burnt by it. I walked away that weekend massively in profit because of the war kicking off, which is horrible to think that, you know, you profit from something like that. But all weekend I couldn't sell. I was so scared, and I barely slept that weekend. And I will never put myself through that again.
I remember that.
Yeah,
I remember the messages.
I was frantic all weekend. I was checking IG's weekend pricing constantly, and I was in a gold long. And gold was being quoted by IG on their weekend pricing like $300 or 300 points up. And I was like, oh my God, if this opens there, and it opened at my target and TP straight away. And it was phenomenal. But at the same time, I'd spent, 2 days stressing. I was with the kids, but I couldn't stop thinking, what happens if this opens up and it gaps 300 points down? And not only do I get affected and lose a load of fees that I have, but my investors also get affected. I was like, that could potentially not wipe my career, but it could be a big stunter. Where it sets me back 6 months or 12 months. And I was like, I just don't want that risk moving forward. Of course, black swans, you can never eradicate that risk, but weekend risk, you absolutely can. Unless you've got a really wide stop and you've already accounted for large weekend gaps, that's absolutely fine.
Exactly. So that's why all gurus online don't. Yeah, all gurus online are lying.
We already know that.
Yeah,
all gurus are lying.
Find a guru that's got a track record.
Yeah, even people who aren't gurus usually lie online anyway.
Yeah.
I'll let you answer, Dr. Ojo, because I think our answers will be pretty much identical anyway.
From wealth of experience, what kind of strategies should beginners focus on with high chances of success? Is this swing trades, higher time frame from what you just said? Yeah, so when I first started actually becoming successful at trading, it was always from a daily to a 4 hour. I did trade in the past, like 1 hour, 15 minute, 5 minute. Never once was there any success from the beginner point of view. I started getting more profitable when I started focusing on higher time frames, and I still stand by that. I still do a lot of my trading from a higher time frame, just because you can get a lot more success with higher time frame strategies. And I put that down to, when you go into the lower time frames, you're competing against proper quants that they're all focused on lower time frames, whereas they're maybe less. Again, this is all hypothetical. Whether this is true or not seems to be we don't know. But I always find that higher time frame analysis and higher time frame strategies, looking at daily, weekly, never going as low as the 4 hour, you will have a lot more success. And it all comes down to, again, trade frequency as well. There's a lot more opportunities in lower time frames than on the daily or the weekly or the 4 hour. So you can actually probably make more informative, good judgment as well. Things are, the faster things move, the more you have to react to them, the more you have to think. The slower things move, the more time you have to react, the more you can be able to make good calculated decisions, or, whether that's making algos around these higher time frames or even manual trading. That's why day trading has the lowest success out of trading. Swing trading, higher time frame things, people tend to do a bit better. Not massively better, but a bit better. If I said everything in higher time frame is easy, I'd be lying, because then there'd be a lot more profitable traders. But from a beginner's point of view, probably where you should start.
I think the only problem that comes in with higher time frame trading, not everybody experiences it, but some people do, is you then get the emotional issue of holding trades for longer periods of time.
Yeah.
And so that it brings a new wave of like emotional problems or emotional blockers, let's say. So you kind of have to learn to get around those as well. I am not built for long-term trading. I can invest, but I can't hold trades for days or weeks usually, because I like to be in and out within a day or a couple of days, but of course that doesn't always happen.
See, I didn't mind it. I remember I showed you like one of my trades I held for 40 days.
I'm trying to implement some longer term holds on XAQT, but like I say, the majority of mine now will be capped at 5 days anyway, because I won't hold over weekends.
Yeah. I mean, most of my trading started off with longer holds. I think my average hold time was like a week, maybe like just over that. But I did have some outliers that, yeah, it just spending over a month in a trade is just, even with, thinking about it now, because the style's changed a little bit. Like, if I hold a trade for like 2-3 days now, I'm like, what's going on? But like, I did used to do that, and it used to, as much as it was good and successful, the swings in my equity when I had multiple open positions were a bit wild. Yeah. And I mean, this is when I was risking 1% per trade. I was scaling in 1% per trade. It was over 6 figures. So I was seeing monthly wages move in like a couple of minutes. And I'll not go into too much more detail, but there were some really good days. There were some really, really bad days as well.
Really horrible days.
But I guess that's where it kind of toughened me up a little bit, because could lose a monthly salary within the space of 5 minutes.
Looks like Rob wants you to review your tickers next week, Blaine.
I mean, I can show you it right now. There's nothing really too much to review as such. I had been testing loads of stuff out, and it's making a little bit of a recovery. We're up 0.3% today, but nothing too great this year. We're actually down for the year, and we've it's not got that. It's not been going that long. Not had too many trades, to be fair, only 220, but this is me just trying to just test out loads of different things. I'm also in this portfolio testing out. So I'm seeing, like, Martin on Tuesday went over optimization, overfitting, and like obviously what is the best sort of way of making sure that you're not overfitting. I'm testing a different method out to see is certain strategies going to be overfitted when you do X, Y, and Z, or is it just, am I overthinking it? I want to come to my own like hypothesis on overfitting and optimization as well. So far, some of the systems working okay, but I've pushed them a little bit more than others. Other ones are doing terrible. So one of them that I've been trading, I've got like 20 strategies on, and 2 of them are actually pretty good. But it's the NASDAQ is really killing me on this. So I'm down 7% on this account just on NASDAQ at the moment. So it doesn't trade very frequent, but again, like, it's worked in the past, and I put it down to, it's a long only strategy, and it's not been too good this year for a long only on NASDAQ too much. So it's almost like the worst time to turn it on. But again, I'll collect the data. I don't really care what return this is, what drawdown it is, what assets under management I have with it. It's just purely from the fact that I just want to have an account that's forward tested, that if anything's good, I can then bring it into my next Darwin, or I can put it on IME. If it passes like stagnation period, drawdowns, returns, loads of different metrics that I look at. So yeah, this is like that's why it's called Blaine Test. And I hope anyone that is ever looking at investments looks at Blaine Test and realizes it's a test account. This is just purely my testing ground. So yeah, we'll see where it is at the end of the year. If it's break even, it's break even. It's up, it's up. I don't expect this to be as stable, nowhere near as stable as IME. I mean, right now the drawdown's less, daily volatility is not too bad, and annualized returns not bad, but yeah, this is just my training ground essentially. What are strategies or types of strategies that you guys love in your portfolio? Also, what do you think of Kaufman books, upcoming or slightly dated? I mean, how do I best answer this? The strategies that I'm purely breakout trader, to be honest. Like, my problem is I don't have enough like things to hedge some of my strategies. So when volatility is a bit up, down, I kind of go break even a bit. But when things are moving my direction, I can really take advantage. And I do need to add some mean reverting strategies in there as well. But yeah, most of my stuff is breakout strategies, intraday. Some of them are like holding a bit longer term, as in like a couple of days. I think my average hold time at the moment is 24 hours, so it's just about a day. But I have a mixture between strategies that might last a couple hours, end of day, might hold 2 or 3 days. There's loads of different things within my portfolio that it's just to kind of give a variety. So I'm catching both intraday, medium term, and long term if a trend's going to happen. Because a trend will happen. That is the truth. To be honest, the trend will happen at some point because it needs to. That's my own conclusion of trading, and it's true. Everything has to move at some point, and there will be.
Trend will happen. Not financial advice, obviously, everyone. But
yeah, but I didn't say what asset. I didn't say trade this. The trend will happen.
The trend to the downside is happening now because S&P is absolutely caking it this afternoon.
Is it? Yeah. See if people listen to the live where I shared them my like a little investment sort of strategy, it'd be all right.
I bought some more earlier.
Did you? Oh, you mad man.
To be fair though, but it was only £100. I just average every so often. When I see a red day, I just stick in like £200. I put it into my pot as metals and like.
Yeah. Regarding books, I don't think there is a bad book if you can take something away from it, implement it, prove it, disprove it. I think all information is good information. Well, that's a lie. If you listen to any YouTube guru on YouTube that's trying to sell you a course with cars, that's garbage. I mean, like books from professionals that actually have credibility. Any knowledge is good knowledge. So I'll rephrase that.
Do you want to say something, Blaine?
Yeah, man.
Who would long this chart? Who would short this chart?
What's that?
Would you long this pattern or would you short this pattern? This triple top.
Mate, I'm well looking at the breakout of that. If I was FTMO right now, I'd watch sharing this. By the way, they can shut your account down in the terms and conditions.
Oh, can they?
Yeah, man.
Oh, I didn't give a fuck. let's see him try. That's cool.
Yeah. I think if you show one of your trades on like FTMO or something like that, they can shut your account down because they can see.
Good job, my open trades isn't on.
Yeah, man. Because what they'll say is you've got 800 people in the stream. They could all buy the same positions as you, and that's classed as copy trading. There you go. Information.
Suck your mum. I literally.
Thank you guys once again for valuing this live. We're trying to share as much as we possibly can to kind of help as much as well.
Yeah, I just a disclaimer. Please don't ban me FTMO. I mean, to be fair, it's highly likely I'll probably blow the account at some point now that they've changed the swing rules. Like, is what it is.
Yeah, I cannot wait for you to get that email.
Getting ahead with Dr. Ojo said, "What's your take on prop firms? If there is no crime talking about stuff outside of Darwinex, not from a competitor?" Yeah, of course. Like, listen, Blaine and I are both traders. Like, whilst we are Darwinex through and through, like my blood is blue. I still trade whatever benefit. Are you laughing at me?
Your blood is blue.
Whatever capital I can have as a trader, like I will have. from a personal perspective, I would trade prop firms, but that's because I've been doing it for like 4, maybe 5 years trading with FTMO. But the problem is it's a very predatory business model, as is many in this industry, you know. And I think it takes advantage of newer traders by alluding to it's easy to pass a challenge and get capital and trade, when we all know that's not the case. Like I say, I consider myself a professional trader now. I'm still a retail trader, but I would say I'm a professional retail trader. I've been trading that FTMO account since September last year, and it's up 17,000, which is what, 8.88%. I'm kind of like their worst nightmare because I'll just trade low risk and probably pass at some point. Oh, oh my God. Did you just see that?
No.
Oh, I'm going to have to watch that back. I just squeezed my bottle.
I generally thought you were reading the FTMO terms and conditions and just stopped speaking.
No, I squeezed my bottle by accident and the water shot out and went all over my desk.
You're too small on the screen for me to see that. So.
Oh, God. Oh, well. Anyway, I'll stop talking.
Yeah.
Prop firms, predatory business model, but I will still use them.
It's a casino for traders. Simple as that. Once they've had enough of you, they ban you for no good reason other than you've made money off them and they've not made money off you. That's as simple as what prop firms are, and that's why they're unregulated. That's why they give you all these sort of things as well. That's true. You know, I'll not say the prop firms that have banned me because I don't think it's good for me to say that. But
it don't matter. You got nothing to lose.
Begins with an F. It's not FGMO, but it's another one. But what's that?
Funding pips.
Nah.
The purple one. Oh, what are they called?
I'll tell you the story. I passed phase 1. They were fine with that. I then passed phase 2, and they asked me to do phase 2 again. And then when I passed phase 2 again, they just straight up said, no, we're not allowing you to trade, and they didn't give me a refund either. Like, literally just said straight up, no, you're not trading on us, because I made 20% with less than like 3% drawdown over the case of like a couple of months.
Does that particular firm offer a bonus if they don't pay you out on time?
I don't know. I've literally
Funded Next, that's the name.
Nah, it's not them.
Oh, okay.
It was one of the ones that allowed you to do algo trading, to be fair, back in the day, but I think they've changed it out now.
Definitive.
It could be.
That's definitely is. Okay. Carry on, Blaine. Sorry to disrupt you, pal.
Yeah, so that's my take on prop firms. I can't complain because some have the ones that I do have given payouts, but again, if you do a low risk model and go under the radar, you'll never really come up on their risk warning. Although, you know, as I grow the accounts with them, getting more and more, that might change anyway. So we'll see. Patty says, interesting you gave away breakout work intraday. I feel the same, but ChatGPT disagrees. Okay, but they do work.
Disagrees with what?
The breakouts don't work intraday.
Well, it completely depends, right? It completely depends, like what if you're trading with a tiny stop and tiny target. You know, yes, the majority of my breakouts, like, or I say the majority, I've got like 2 or 3 of them. They are intraday, but it's not like they don't close every day as a rule. It's just because of the size of the stops and targets, they usually close on the same day. But any strategy will work given the right market, the right time, the right place.
Yeah.
You know, it's just what you got to remember. Even though Blaine and I build loads of strategies and test loads of strategies, and you try and eliminate bias, there is still bias in every word that comes out of both of our mouths based on our experience of what we've built and what we've tested. So there will be edge that Blaine and I have not been able to build, and there will also be the flip side to that, like edge that Blaine and I built that other people will struggle to build just because of different experience. So yeah, there's edge in anything. You've just got to find it.
Absolutely. Anyway. Right. Anyway, we'll cover Thomas's Darwin, and then I think we'll call it a day for today because that's been an hour and a half already.
Hold on. I just tested one of my euro dollar breakout system, and I did out of sample 24 to current day, and it's got a 95.2 profit factor. 100% win rate, you know. But that's because
it's leaderboards. That's good up for the leaderboards.
I split my orders 5 times, so it looks even better. But yeah, 95. Oh god.
Okay, so quant capital. So PHRT, everything is looking really, really good so far. 54% return technically, with all just less than 6%, near 5% drawdown. That is really, really good. You can see that your assets have jumped up massively just since this whole month, basically. Yeah, big jump. So guess is, I don't know, maybe 18 investors. I can imagine more will come with the returns, but the returns this year are absolutely crazy good.
Wow.
This has got to be the best start to 2026 that I've actually seen this year. It's got to be
7%, 2%, 11.
Yeah.
Oh, Blaine, we need to get a plug into this guy's MT5. I'm only joking. I definitely don't have access to do that. That was pure banter. What assets trading?
So a lot of commodities. So 500 trades on NASDAQ, 30% return, pretty good. Dow slightly down, but well, break even. Gold, 40% return. Yeah, gold's just been so good.
I'm presuming there's been some shorts on gold which are paid this month, right?
Massive. Yeah. Silver up as well, looking good in terms of win rate as well. Dollar yen, yep. Again, I agree, disappointing this year. But yeah, it looks like a good balanced portfolio where, you know, most of the currencies are kind of break-even-ish. And I put that down to basically, like, definitely over the past couple of months. Well, I suppose this record is actually quite long. So, yeah, I mean, mostly I would say, Thomas, you're obviously a gold, NASDAQ, gold and NASDAQ trader, which, you know, nothing wrong with that. Perfect markets for breakout, trend following, and loads of momentum and volatility, which is always good markets to concentrate. You know, that's why I want to get into NASDAQ because I've never traded it before. But
yeah, those are the two markets that SYO trades, and he's the biggest trader at Darwinex.
I mean, no wonder, because, you know, I've just always stayed away from indices because I've never had quality data on it, but that's obviously going to change soon because we're getting more data. So it'll be interesting. I'm interested to see how the NASDAQ does this year, because obviously, you know, we can see that it's struggling at the moment. Things are going down. So I'll be interested to see the strategies that I've built pre-2026, how they handle 2026. Because I'm not going to apply them live until, you know, I see the full year's history at the end of the day. But yeah, everything's looking like a really good distribution of trades, decent returns, good American and Asian market. Just the European session slightly lacking, so maybe take a look into that. And again, days of the week, we can see that Thursday again is your worst returning day. So I don't know if you've got any sort of like data on Thursday. Maybe have a look at certain strategies, or it could just be complete randomness because you've only been trading for just less than 3 years. Everything's looking good overall. Looking at strategy analysis, yeah, good. I mean, that's a good mixture. Just 60% long exposure is not bad, especially when gold over the past Nasdaq, and you're trading Nasdaq and gold, which is pretty impressive. So
I'm
good win rate.
Darwin.
Yeah, definitely do. Thomas, you've been bookmarked.
You've been marked.
You've been marked. Big X. So yeah, again, losing trade. So you're obviously like got a decent sized stop loss because, you know, your trade duration is quite high in terms of like your losers are just about 2 days, your winners are just about 2 days as well. So quite a good distribution again in terms of duration. Yeah, I can see big difference in VAR. VAR is, pretty healthy. It's moving up a little bit, but overall, this is probably what you're going to see when you're trading certain assets anyway with volatility. So everything's looking pretty good. Let's check capacity. My guess is because you're longer hold trading, your capacity will be probably pretty good. Yeah, capacity is pretty high. I mean, look at that candle. That is.
I checked. It was a gold trade that I think you walked away with 7-point-something% on.
Do you know what? I'm probably just going to wait until he drops down and then place a breakout on his high. maybe that's an idea. Maybe we trade breakouts at Darwin's. That could be an interesting project.
I think that's kind of what Darwinex Labs does for the hedging, isn't it? Probably.
I mean, I think it's not a bad idea, to be honest. Yeah, going back to the story with capacity, let's have a quick look. So capacity is just over 200 million, which is good. There's thanks for the awesome quality feedback, guys. Yeah, no worries. Yeah, if you want to fire trading strategy ideas my way, I'm always open. I'm joking. But no, capacity is really good as well, so I wouldn't be too worried about capacity. Again, if you're here for the stream earlier on, obviously Kieran talked about how to increase capacity. So I don't think you need to worry at the moment, Thomas, but maybe if things keep going the way you are, you might get good.
Check his investor tab line, see his live capacity.
Where did we check this?
So what's the percentage here? I can't read it on my screen because I've got
percentage of use capacity.
So you see the chart there?
Yeah.
Let me make this full screen. So is that say 1.92%?
Yeah.
Oh yeah, so his flow is really good. Scroll down. Average slippage by investor volume, 0.04 pips. Yeah, like that's unbelievable. His average slippage is actually positive. So you're using 2%. So his real-time cap is about 100 million as of right now, based on this, which is like phenomenal.
Yeah. I think that's pretty impressive. Especially positive slippage on gold lately is really impressive. Because I think gold's where a lot of the so the Dow's where his biggest slippage was. Yeah, again, most of it will be. Yeah, I mean that's pretty solid. Keep up the good work, because that is an impressive Darwin so far. Let's see the delayed strategy. Yeah, interesting.
Not much difference between Darwin and the signal, is there?
No, it's looking good for that. Open trades, always about. Interesting though, like your open trades this year have been a little bit less than what they were previously. Interesting for that. Yeah, no, everything's looking good. Definitely one we'll need to keep an eye on for the future. PHRT. There we go. Okay. Unless you have anything else to share, Kieran. I mean, I think we've covered quite a lot today. Intraday trading works if you have a wide stop loss and on the right direction. Yeah, but also works with a decent tight stop loss as well. It just depends on what market you're trading.
So it's just testing my euro-dollar breakout system. I still can't get over a 99-point profit factor. But yeah, okay, cool. Well, we are way over the hour that we usually spend on this call. So you guys have been treated well this week. You had a 2-hour session on Tuesday, an hour last. Well, it was shorter one last night, wasn't it? And almost a 2-hour session tonight. So yeah, hopefully you guys have taken a lot of value from the kind of the topics and the stuff that we've gone over this week, specifically in today's session and Tuesday's session. We're always more happy to we're always happy to spend more time on these sessions going through things. If there's guys like you guys here today, if you're here, if you're interacting with us, if you're in the comments, so please, if you come to these sessions, always feel free to get involved. Always feel free to ask questions or to, you know, stick your hand up and say you like your strategy reviewed. That's the whole reason that we're here, right? So we will be back on next Tuesday for a strategy development session, which will be, you know, back like what we did last week, where it's just myself and Blaine, where we go back to building with the idea of putting strategies onto the charity Darwin. So I just want to say a massive thank you from both myself and Blaine. Oh, I'm getting a notification that my monitor's about to turn off. Let's just get rid of that. There we go. A massive thank you to all of you guys for joining, and a thank you for everybody who's allowed us to take a look at their Darwins and put a comment in the YouTube comment section for this stream. I hope you all have a fantastic rest of your morning, afternoon, or evening, wherever you're watching this from in the world, and we will catch you in the next session. Peace out, guys.
See you there.